So let's be real, buying a home is a stressful process. One of the most stressful parts about it is getting a home loan. With so many lenders out there and so many types of loans, it's difficult to tell which is the best route. Stay tuned to find out. Hey everyone, my name is Ryan Schramm, your local San Clemente realtor. Today we're going to talk about the most popular types of home loans. Before we get started, I just wanted to stress to you how important it is to use a local lender. The reason being is your lender plays an integral part of the purchase of a home. And when you go to make an offer on a property, that listing agent, the person working for the seller, they're going to want to know, where did this lender pre-approval come from? Did it come from an online company where you can just jump online and fill out a form? Listing agents don't want to see that. They want to be able to call your local lender, pick up the phone and say, hey, how is this buyer's pre-approval? Did you look at this? Did you look at their income? Did you look at their FICOs? They want to actually pick up the phone and talk to somebody so that they can decipher, is this buyer actually pre-approved? On that pre-approval letter is going to be the type of loan the buyer is getting to finance the property with. So let's talk about one of the most popular types of loans. The most popular type of loan is a conventional mortgage. A conventional mortgage is a home loan that is not insured by the federal government, and there's really two types of conventional loans: conforming and non-conforming loans. So a conforming loan simply means that that loan amount falls within a certain limit set forth by the Federal Housing Finance Administration. The types of mortgage loans that don't fall within these set limits are called non-conforming loans. Generally, lenders are going to require you to pay private mortgage insurance for when you're borrowing more than 80% of the home's value. So that means you're putting less than 20% down. So let's look at some of the pros of conventional mortgages. One, they can be used for a primary home, a second home, or an investment property. Two, overall borrowing costs tend to be lower than that of other mortgage types, even if interest rates are slightly higher. Three, you can ask your lender to cancel PMI once you've reached 20% equity. That's huge. Four, you can pay as little as 3% down on loans backed by Fannie Mae or Freddie Mac. So what are the cons of conventional mortgages? Minimum FICO score of 620 or higher is often required. You must have a debt to income ratio of 45% to 50%, and you'll likely need to pay PMI if your down payment is less than 20% of the sales price. Finally, significant documentation is required to verify income, assets, down payment, and employment. Most of the time, conventional mortgages and fixed rate mortgages, they go hand in hand. Fixed rate mortgages means the interest rate is going to be the same for the entire duration of the loan. Fixed interest rate loans typically come in 15, 20, and 30-year timetables. So let's go over the pros of a fixed rate mortgage. One, your monthly principal and interest payments stay the same throughout the entire life of the loan, allowing you to budget and know exactly what you're going to pay. And two, you can more precisely budget other expenses month to month. So let's go over some of the cons of a fixed rate mortgage. One, you're going to end up paying more interest over the life of the loan. If you lock in a 30-year fixed, obviously you're paying interest for 30 years. That means your total interest at the end of the loan life is going to be higher than if you did, say, 15 years. Additionally, since you're paying more interest over the life of the loan, it's going to take more time to build equity in the home. And interest rates are typically higher on a fixed rate loan because the security of knowing that that rate is fixed, that rate's going to be higher than an adjustable rate mortgage that fluctuates with the market. Next on the list is jumbo loans. Jumbo mortgages are conventional types of mortgages that the loan amount is above the set limit. Remember we talked about the set limit for a county earlier in this video? Anything above that is going to qualify as a jumbo loan. For 2021, the average across the United States for the upper limit, that loan resembling a jumbo loan, was about $548,000. In certain high cost areas, which Orange County, where I'm at, is, for example, the conforming loan limit, meaning anything over that as a jumbo, is $822,000. Jumbo loans are definitely more common in higher cost area where housing prices are higher, and they're going to require substantially more documentation through the loan approval process. So let's jump into some of the pros about jumbo mortgages. 1, you can borrow more money to buy a home in an expensive area. 2, interest rates tend to be competitive with other conventional loans. So what are the cons? Jumbo loan down payment has to be at least 10 to 20%. A FICO score of 700 or higher is typically required, although some lenders will accept a minimum score of 660. You cannot have a debt-to-income ratio above 45% for a jumbo loan, and you must show that you have significant assets, generally 10% of the loan amount in cash in the form of a savings account. So there's also a handful of government-issued mortgages. The US government is not a bank or a mortgage loan, but they do play a significant role in helping Americans secure housing. 3 government agencies back mortgages: the Federal Housing Administration, which is commonly known as FHA Loans, the Department of Agriculture, USDA Loans, and finally, the US Department of Veteran Affairs, also known as VA Loans. Okay, so let's jump into FHA Loans. As a realtor, as a listing agent who represents sellers and buyers, I have a ton of clients who utilize FHA loans. Here's why they're great. They only require a low percentage down. So an FHA loan is 3.5% down. Also, the FICO scores, your credit, the FHA allows for typically a lower credit score. In fact, that minimum credit score is 580, and they even have an option if you want to put 10% down, your FICO score can be as low as 500. Also, FHA loans require PMI, private mortgage insurance. Part of that PMI is paid up front as a closing cost. The other portion is paid throughout the life of the loan. All right, so VA loans are another form of loan that we've talked about. I absolutely love the VA loan. I think it's one of the things our government does right for our veterans. These people who are enlisted in the military, they've done so much for our country, and the VA loan allows active duty or previously enlisted military to get a 0% down home loan, as well as not having to pay any private mortgage insurance, which is huge. And the rates on these VA loans are exceptional, so I'm a big advocate for VA loans. Finally, USDA loans. USDA loans help moderate to low income borrowers purchase in rural areas of the country. Some USDA loans don't even require a down payment for borrowers. So let's cover some of the pros of these government home loans. They help you finance a home when you don't qualify for a conventional loan. Credit requirements are more relaxed. You don't need a large down payment, and they're open to repeat and first-time buyers. So what are the cons? Many of these loans have mandatory mortgage insurance premiums, except for VA. You could have a higher overall borrowing cost, meaning that your equity is lower, which can get kind of dicey if the market shifts. And you need to expect to provide more documentation depending on the loan type to prove your eligibility. Finally, there's adjustable rate mortgages, better known as an ARM. Unlike the stability of a fixed rate loan where that interest rate is locked in, the adjustable rate mortgage is going to fluctuate. The interest rate is actually going to change with what the market is doing. Oftentimes, an ARM is going to have a fixed rate for say 3 to 5 to 7 years, and then that rate is going to change. So in a current lending environment where mortgage interest rates like today, they're super low, an ARM might look like a really appealing option because you can lock in, let's say, a 3% interest rate for 3, 5, or 7 years. But the big question looms, what is the market going to be doing in 3, 5, or 7 years? So you're really rolling the dice on an adjustable rate mortgage. So we just kind of covered some things to be careful of on an ARM. The pros to these loans are you'll enjoy a lower fixed rate in the first few years of home ownership, and you'll save a substantial amount of money on interest payments because of that. And then of course the cons to the ARM are your monthly mortgage payments could become unaffordable, resulting in a loan default like what happened in 2007, 2008. And home values may fall in a few years, making it harder to refinance or sell your loan before the loan resets. All right, so I know this was a lot of information to take in. If you guys have any specific questions as to what type of loan to get, or better yet, you want a reference to a local lender, please feel free to reach out to me. Thanks so much and take care.